option traders. For today's trade, we are looking at a neutral option play in investment banking stock and Dow Jones component, Goldman Sachs. The stock has been on a tear higher since early October, with shares up 17% in October and up over 10% so far this month. Goldman Sachs' relative strength line also indicates strong outperformance and is striking new highs, as indicated by the RS line blue dot. The Money Center Bank shows a recent breakout on the daily chart above 358.72, which is a buy point, and is also approaching another buy point at 426.26. However, after such a strong run for the stock, it's reasonable to expect a slight pause in the action here. So investors could consider using an iron condor with a slightly bearish bias to trade Goldman Sachs stock. An iron condor is a risk-defined strategy, which means that you know your maximum loss potential ahead of time, and it's also not unlimited, which is a good thing. The strategy is made up of two credit spreads, a bull put credit spread and a bear call credit spread. So remember, with options, there are two types that you have. You have calls and puts. And with both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy it long or sell it short. Both bear call credit spreads and bull put credit spreads are made up of one short option and one long option. Both credit spreads allow the seller to collect a premium upfront for initiating the trade. For the iron condor, we're putting on both a call credit spread and a put credit spread at the same time. Again, each spread is made up of two option contracts. So that's 4 option contracts in total for the iron condor. And this is a great way to get exposure to a stock without taking directional risk. Although some iron condors can have a slight bullish or bearish bias depending on how you set it up, which is what the trade we're doing today has. So iron condors are neutral trades where the underlying assumption is that the stock will not move really in either direction, up or down, to any very large extent before the expiration of the trade. Iron condors serve to take advantage of a volatility contraction in a given stock. For example, like when a stock is going into earnings. Put simply, this trade is ideal to use when an underlying stock has a slightly higher than normal volatility. These strategies benefit from the passage of time and any decreases in implied volatility. By combining a bull put credit spread and a bear call credit spread, they create a spread of spreads that is the iron condor. Both the calls and puts are on the same underlying stock and have the same expiration date, but each leg of the trade has a different strike price, and that creates the range. The distance between the strike prices for both the bear call spread and the bear put spread with the iron condor should be the same. And that symmetry keeps the trade non-directional. The investor can expect a profit or a loss on the iron condor based on where the stock finishes within that range upon the expiration date. So let's take a look at my trading platform and set up a real-life trade. So to set up this trade, first we're going to use ticker symbol GS for Goldman Sachs. And we're going to select iron condor as the spread type in this box here if you are using thinkorswim. And make sure you are in the December 16th expiration. And down here I have the trade set up and ready to go. So we are looking at selling one December 16th 415 call, buying one December 16th 425 call, selling one December 16th 355 put, and buying one December 16th 350 put. Using the December 16th expiration, we could sell the 355 put and buy the 350 put. This creates the put credit spread part of the trade. And then to create the call credit spread, we're going to sell the 415 call and buy the 425 call. In total, this iron condor will generate around $1.65 per contract, or $165 of premium. The profit zone here ranges between 353.35 and 416.65. This can be calculated by taking the short strikes and adding or subtracting the premium received. Notice that the spread for the put side of the iron condor is narrower at only $5 wide versus the call side, which is a spread of $10 wide. If we take the premium of $165 divided by the maximum risk of $835 in the case of the two calls if Goldman Sachs traded above $425 expiration. This iron condor trade gives the potential to return 19.8%. A stop loss in this case might be calculated based on 25% of capital at risk, so a loss of around $210. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.